Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from global tax policy to the OECD's latest developments. I'm Doug McHoney, PwC's International Tax Services Global Leader. PwC's Pillar 2 engine, powered by Beacon, is a game changer for Pillar 2 modeling, provision, and compliance calculations. Built on a graph system utilizing over 20 years of international tax technology, this cloud-based centralized rules engine is developed by a team of Pillar 2 tax experts from around the globe. PwC's Pillar 2 engine is currently available as a service and is now available to license. On this week's episode of Cross-Border Tax Talks, we're back in Washington, D.C. in PwC's Policy on Demand studio, where I'm excited to have Will Morris back on the podcast. Will is PwC's Global Tax Policy Leader and formerly served as the Director of Global Tax Policy at GE. Will, welcome back to the podcast.
Thank you very much, Doug. Why you keep inviting me back is beyond me, but I'm delighted to be here.
Thank you, Will. We have plenty to cover this year in kind of a global tax policy wrap-up. But before we do that, and you have been on this podcast numerous times, so I know better to ask you than about baseball, so we won't go there.
Good.
But I also know that you're a studied theologian and a regular reader. Do you have any good books that you are currently reading or anything you would like to share with listeners?
Well, I do. So I don't get as much time to read as I would like, but you and I were both in Lisbon just a couple of weeks ago. And I remember from my school days, one of my history teachers, who will turn 100 very shortly, talking to us about the Great Lisbon Earthquake of 1755, which totally reshaped the city. But it was also this huge, huge change in the way European intellectuals thought about God, and about the Enlightenment. It was this huge, huge break, and it influenced Voltaire and various other thinkers. Anyway, this book is called This Gulf of Fire, and it is a fabulous read. I mean, it's written by a professional historian. It's very well reviewed, but it's a page turner. And so there were three elements to the Great Lisbon Earthquake. The first was the earthquake itself. The second was a series of tsunamis caused by the earthquake, and then the third was the fire, which was caused by the fact this happened on All Saints' Day, so all the churches had candles in, all the houses had things ready for them. And then it goes on to talk about the intellectual impact of this. And, how do you think about, in this case, a God who can allow this to happen? So it's a great book. I mean, you may not think of yourself as a history fan, you may not think of yourself as a nonfiction reader. Read it, because it's great from both points.
All right, I'm gonna check that one out. And I typically will read nonfiction and then also do a lot of leadership books, but I was recently suggested a book from one of my friends in St. Louis called How High We Go in the Dark by Sequoia Nagamatsu. An amazing, I haven't read fiction a lot. We both read so much tax material, it's hard to find time, for some of the personal reading. But I've just been engulfed in this, no pun intended, with your prior with your prior recommendation. But
it's an earthquake for you.
Yeah, How High We Go in the Dark by Sequoia Nagamatsu. Great fiction book. All right, so let's get on to, we don't need to turn this into a book club, as fun as that might be.
Yep.
But did want to get to global tax policy and really kind of focusing on where we've been in 2024, what we can expect in 2025. And I think we have to start with the with the election of Donald Trump and the pending Trump administration. So with him heading to the White House, we're at the confluence of trade policy and tax policy unlike any time in recent history, at least certainly during my career. So the first kind of broad question, and particularly given your experience in industry before you came over to be an advisor, we're at such an unbelievable time of uncertainty. How can tax executives communicate this risk, particularly with respect to tariffs, but just some of the broader tax issues to their stakeholders, including the C-suite?
Right, it's a great question. I mean, actually, and going back to history, just for a second, I'm constantly reminded, there's a great saying of Lenin, the Russian revolutionary, that there are decades when nothing happens, and then there are weeks when decades happen. And
I love it.
I think we're in the latter.
Feels like, I hope so.
Just to be clear. Yeah. There is just so much happening. And, as a chief tax executive, how do you explain these things? Because some of your stakeholders will think that tariffs are taxes, others will think that tariffs are completely separate from taxes. So the way that I suggest to people, particularly when they're sort of talking upwards, if you will, as opposed to, to their own staff, is tie this to the big macro events and say, here are the things that are happening, and then here's how it can feed down into tax. So take tariffs, for example. You don't have to say that they're taxes, because they're not taxes. They're not dissimilar in some respects. And, at least within your department, you should make clear that the direct tax folks need to be talking very closely to the indirect tax folks, who need to be talking very closely to the customs and trade folks, who now need to be talking to the tariffs folks as well. So there needs to be that connectivity. But, you know, it's also important for people to understand that what happens on the tariff side can have huge impacts on the tax sides. I mean, take a couple of very small examples. I mean, a couple of obvious examples in a sense. You know, tariffs, where you do business, what that means for your supply chain, can be very impactful. So, you know, tariffs can affect that. What you do with your supply chain obviously has huge impacts on tax, because then you have to think about transfer pricing, but you also have to think about, you know, exit taxes, for example. Are you going to be charged on various things? Likewise, what happens in the tax area can very easily spill over into the tariffs area. DSTs is an obvious example there, digital services taxes, because, you know, we've seen this show before, and therefore, you know, if we get more DSTs, at least in the US, we'll be talking about 301s, and then we'll be talking about, you know, tariffs over there as well. And then
we're going to come back to that.
You know, and then you think about, you know, sort of the geopolitics of this, and you think about, well, what does this mean for China? We've had a lot about China tariffs. But then, okay, well, there are going to be other aspects of that as well, because that bleeds into Pillar 2. So again, you know, it's tying it together, and it's making it not sound dry, but it's actually starting with, you know, senior management. Here are the things that are impacting your business, and then here are the tax aspects of that. And I found that to be quite a powerful but also helpful way of actually illustrating to people that you need to think about tax, you need to think about tariffs, and actually everything in the end is interconnected.
Yeah, so maybe a couple things that I would pull from that. First is your comment on bringing these multiple teams together that historically have sit maybe in different departments.
No, silos are a disaster,
yeah.
Absolute disaster.
And, but this, of course, you know, I can't help but think about it in the context of Pillar 2, right?
Sure.
As we think about customs and trade and potential tariffs, as we think about Pillar 2 and the need for systems people to be working with the tax people, to be working with the financial accounting people, is that, you know, it really feels like an unprecedented time where businesses now have to have these cross-functional teams to be able to deal with these issues. And maybe the second comment that I would make is that, you know, I think if there's one thing that taxpayers want in general around the globe, whether a US multinational or non-US based multinational, is certainty. And business people are going to make decisions, long-term decisions, based on, you know, what potentially is certain. And you know, the fact that, you know, Trump will be a one-term president, he's got 4 years, and the fact is that if major tariffs are imposed, trying to move manufacturing plants takes years.
It does.
Right? And so it will be interesting to me to see how this plays out, in that, you know, is this just 4 years? Is that enough time for companies to potentially really make significant changes to their supply chains? You know, if domestic manufacturing, and particularly given robots and automation that has really transformed how the manufacturing process, it's going to be interesting to me to see how some of these policies actually play out with business decisions.
Yeah, so there are there are lots of interesting things there. So one of them is, I mean, I agree, you know, you will rarely close down a huge manufacturing plant, okay? But you might close down a small manufacturing plant. Yeah. But equally important is, where does your marginal investment go? And that is something which is impacted by today. I mean, yeah, you're going to pare down the road, but if you think, I have 4 years of this going, and, you know, I need to make some investment decisions, that is actually going to guide your investment decisions. So that's point one. So, you know, you can have small changes, you won't have the large changes initially, but then you go on beyond that. I want to come back to certainty, though, because one of the things, you know, I've spent decades and decades saying, you know, we all want stability and certainty. Yeah, okay, well, we're not getting it, right?
Yeah.
I mean, we're getting neither stability nor certainty. In fact, it's getting worse, and, you know, we'll come back to that as well. But the one thing, almost the first thing that I learned when I was at GE from my boss, the great, legendary John Samuels, was no surprises. We can deal with bad news, but we can't deal with surprises. So, you know, when I talk to businesses about that, I say, stability would be fabulous, but uncertainty, but we're not going to get those. So to a certain extent, you have to lean into the uncertainty. And what that means is, sure, you have to try and keep, you know, a focus on a lot of things. But again, when you're talking, I mean, you know, particularly chief tax officer, but also people feeding up to the chief tax officer themselves, you have to say, look, there's uncertainty here, but here's what we know. here's what we think is going to happen, may happen, could happen, here's the range of options, and just make sure there are no surprises. And that also means that the most important type of planning is no regrets planning. So again, we're not going to get stability and certainty, and we can whistle for that as much as we want to, but actually we live in an age of increasing uncertainty. And again, going back to those macro factors, it's not all about tax. A lot of it's about geopolitics or globalization, or now the withdrawal from globalization, digitalization, AI, you name it. So we have to live with that uncertainty.
All right. So, Will, I think we've, at the risk of putting words in your mouth, we've both publicly declared the death of Pillar 1 Amount A. Particularly with the Trump election, Republicans taking control of Congress, the U.S. is not going to sign up for Amount A. But I think the consequence of that is the potential proliferation of digital service taxes around the world. And that could significantly impact some of the largest U.S. MNCs. Can you remind us what happened with France's DST during Trump's first administration and what we may be able to learn for that as we prepare for the future and other pending tariffs?
Yes, I mean, I think I would agree with you that to say Pillar 1 is dead, it sort of indicates that we have a document that we can say has not, it hasn't happened.
Yeah.
We're told that the document is stable. Whether stable means ready, nobody's working on it, or dead, we don't know, but it's stable.
Okay.
My guess is we actually will see something in the next couple of months, and it'll then go nowhere. But yes, the Amount A thing isn't happening.
I didn't say that people were stopping working on it.
No, I think they have, actually, but that's a different issue again. And obviously with the change in administration here, whatever pressure there was to try to come to a conclusion has gone. But DSTs in France, obviously there was a big fight about this. There was a 301 investigation.
Which is one of the sections that allows the president to be able to administer tariffs without congressional approval.
No, that's right. So there has to be an investigation, there has to be a finding. Both of those happened, and with a couple of other countries as well. There was a little bit of personal diplomacy between Mr. Trump, President Macron, Mnuchin, etc.
Right.
And in the end, where we came to was a sort of standstill, effectively. And this was then extended outwards to some of the other countries. But essentially, we've now, for the past 4 or 5, 6 years, been in this position where these countries are collecting the DSTs, which is a nice position to be in because having the money is like 9/10 of the game, right? But when eventually we get to some type of agreement, then sure, there's going to be this credit against the Amount A credit against your income tax as well. Okay, that was never going to happen.
Right.
So here we are. 6 years later, they've been collecting a ton of cash.
To your point, with the thought or hope that, once Amount A is resolved, then that will be refunded or credited to those taxpayers.
Yeah, you've heard my split screen analogy before, which is like sort of Wizard of Oz over here with sort of very happy people, munchkins, and lots of color and happy music, and the sort of the film noir over here.
All right.
I never quite believed the Wizard of Oz story on this one. So, we're back to that. But we also, there has been a lot of movement on DSTs since then. Obviously, Canada has enacted a DST. The current administration has put that into the USMCA process, which pushed it out beyond the election. But there are clearly other countries that are thinking about it as well. And the potential scope of these DSTs has increased. And, we've also seen much more talk at the UN, for example, about the use of withholding taxes, gross basis taxes. And so I wouldn't say that DSTs are a thing of the past. We will definitely see DSTs. But what we now also face is much broader use of I think, gross basis taxes.
Mm-hmm.
And obviously for a business, that's a disaster because that can eat up your profit in a very short period of time. So I think it's a I was going to say brave new world. It isn't. It's a new world. And to that uncertainty I was talking about before, there is going to be even more of it.
Yeah. And if I remember correctly, those tariffs were threatened, right? That the Trump threatened to impose tariffs on France for the DSTs, but I don't think they were ever actually.
No, well, they were real enough that I actually went out and bought a case of champagne speculatively, just in case that they came in. But
and Yeah, and so it'll be interesting to see, are those continue to be threats? Will we actually see the imposition? To your point, there are many more countries that have now brought in DSTs into their domestic legislation, including Canada.
Yeah, and it's worth mentioning that, we don't know a huge amount of detail about what the incoming administration would do on tariffs. I mean, obviously, the president-elect talked about it during the campaign, and there was talk about it, a general 10% tariff on anything, on everything, 60% tariffs on EVs. But, one of the things that is generally thought to be more effective is actually much more targeted tariffs on, sort of high-value goods, high-profile goods. So, you can go back and look at the list which was suggested for France, which I think did include champagne.
Okay.
But,
I thought it excluded wine, but I think maybe champagne.
Well, I think there was a sparkling exception.
Okay.
But, also, other, sort of luxury goods, effectively. And likewise, you can target US things in the same way.
All right. So now want to spend a little time with Pillar 2 and then also come back to the the potential Republican reactions to this. But a couple of large news publications have stated that Pillar 2 is in peril or even the pending death of the OECD pillars. Again, I will agree with amount A for Pillar 1. But you addressed this during one of your weekly global tax talks and 60-second videos that, by the way, Will, I would highly recommend listeners check out on LinkedIn, although I will caution them that I'm not aware of any of them that are actually 60 seconds or less.
It's a brand name.
It's a brand name. I mean, but maybe 120 seconds-ish.
Ish.
It's short. It's short, it's punchy, and you cover a lot of content. I love it. You publish them on Mondays. I would encourage people to check it out. But, Will, is Pillar 2 dead?
No. Of course it isn't. Look, I mean, we have to split Pillar 2 out. It's not just one thing.
Right.
There are two major elements to it, and then the one that I will spend a little bit more time talking about itself has two elements to it. So obviously there's the income inclusion rule, and in the income inclusion rule I'd include the QDMTT as well, qualified domestic minimum top-up tax.
Yep.
Essentially what that side of Pillar 2 does is just raise people's tax rates to 15%. I mean, big deal. I mean, don't get me wrong. In one sense, the OECD has clearly moved the dial here because a large number of countries have done this. But the other side is the UTPR. It used to be the undertaxed payment rule. In December 21 became the UTPR, which the UK then helpfully decoded as the undertaxed profit rule. And again, there are two elements to that, one of which is a bit of a surprise and the other of which is, in a sense, straightforward, but still contrary to a whole series of international law provisions. So it applies firstly at the ultimate parent entity jurisdiction. And this, in a sense, was a surprise. We knew when people talked about the UTPR, even when it was the undertaxed payment rule, that they were focused on things like FDII, for example, FDII. But what happened in December 2021 was essentially this provision which said, if in a country where a parent entity is headquartered, there is no IIR, there's no sort of qualified Pillar 2 tax, then other countries can tax that under the UTPR. The UTPR is totally formulaic. It has nothing to do where income is earned, and it is imposed on subsidiaries of the parent entity in that country. That is a shocker, really.
Right.
An absolute shocker.
Extraterritorial taxation, I
indeed,
think, as one of my law professors may
indeed.
have called.
And one of the problems was that for one reason or another, the US Treasury was simply not paying attention to this, and in particular the fact that this is triggered by non-refundable credits. Refundable credits, which the UK has, large amounts of subsidies, which Germany has, fine. Non-refundable credits, which the US has, not so fine. And there's a sort of a paper-thin accounting justification for this, but it is paper-thin.
The above the line versus below the line.
Yes,
right.
thank you, we're done. But then there's the second part of the UTPR, which is essentially, which enforces this across chain and down chain. And for the IIR to work, you do need some type of mechanism going that way, probably.
Going sideways.
Going sideways, in order for it to work. However, you don't necessarily need one which contravenes tax treaties. Now, again, there have been rationales given for why this doesn't contravene tax treaties. They're not entirely convincing. We find ourselves now with this case in the Belgian courts about whether this violates the EU's four freedoms. But there are also straightforward tax treaty claims that essentially what you're doing under the UTPR is you're taxing income which doesn't arise in your country because you're applying a formula to it, as opposed to actually looking about what's happening under the authorized OECD method or whatever it is that you choose to pick. So, there are a number of reasons why there probably needs to be some mechanism, but the UTPR itself is not quite the right way of doing it, I don't think. And, will be subject to challenge. It's also against international investment agreements, in some cases, BITs, bilateral investment treaties. So the UTPR, the IAR, solid.
It's it's a CFC regime. Same with the QDMT, albeit on this very new, different tax base on financial accounting principles.
But the UTPR is, it's up for grabs. And, as you said before, because there's this transitional safe harbor for the UPE part, which takes us through to the end of 25, this is not yet a significant political issue in the US. You hear about it, but it's not quite biting yet.
Right. So the point being is that the U.S. tax base will not be subject to tax because they have the UTP safe harbor. But just caution listeners that if you are a U.S. MNC, if you operate in one jurisdiction that has implemented the UTPR, it means all of your subsidiaries, other than the U.S. parent, are still subject to the UTPR.
And obviously bear in mind that the EU has done it, so you have 27 jurisdictions already which are looking at it. So, that part of it is, that is going to be in effect from 1/1/25, cross-chain down the chain. So, the UTPR will be with us. But the US part of this becomes, unless, as you say, the tax rate drops below 20%, which would take you out of the safe harbor, this becomes more pertinent at the end of 2025. But it is going to get attention. Now, how it gets attention is interesting because the huge focus in the US, and obviously we're sitting here in Washington, D.C. in particular, in 2025 is going to be the Tax Cuts and Jobs Act reauthorization. So what foreigners are doing over here may not get the amount of attention that it needs to until it gets very close to the end. But we're going to talk about last year's legislation in a second. So let me stop there.
Yeah. So maybe a couple of things just to pull from that is, despite some of the tax treaty issues, bilateral investment treaty issues, we know there's this case that has been filed in Belgium about whether it's compliant with EU law. To your point, the entire EU, I think it's close to 30 countries, have enacted the UTPR, which goes into effect January 1st, 2025. Right. So companies will still need to comply. They'll still need to provide. We'll certainly see how things shake out. But just want to caution listeners.
No, absolutely. So not dead. And of course, I know from my experience of being in a business is that you can hear your advisors say, it's almost certainly going to change. But you as a business have to follow the law as it stands, which means that when it comes to collecting the data and filing the returns and doing all the rest of that stuff, the law is what it is until it isn't. And that's a problem.
Yeah, and the way I interpret this, some of these news organizations that have talked about Pillar 2 being in peril, the way I've tried to explain it is that the broad-based goals of getting all of the world's major economies, frankly, both developed and developing economies, under one system of taxation, which is Pillar 2, that is in peril. I think that, the fact that the U.S. is not going, I think there's no way that the Trump administration or the Republicans are going to adopt Pillar 2 sort of as prescribed in the model rules, commentary, and administrative guidance. Yep. It'll be interesting to see how China and some, the other large economy, or India, for example, if India continues to move forward, what China does. And so with that respect, I do think it is that goal of having one common tax base around the globe is certainly in peril. That may be dead. But the fact is that we still have countries that have enacted. We know that there are a number of countries that will be enacting those rules.
Yep, no, absolutely. And, there is what Pascal Saint-Amand used to call critical mass. With the EU, with the UK, with Australia, Canada, etc. There is that critical mass to enforce something like the UTPR, at least cross-chain.
And if we think about some of the original goals of the OECD, if we can remember that with Pillar 2, right?
This is like in 1918. We're talking, what? This war started in 1914?
And it was to stop the race to the bottom, right? I mean, to use
which perhaps one had already done, but yes, okay.
Right, but I think if you want to call some success for the OECD in this initiative, we've seen a number of the sort of island countries, if you will, that are enacting or have enacted Pillar 2. We've seen some countries enact corporate taxes that historically have not done this before in Bermuda, Barbados. The UAE also implemented things. So I think if you were looking to see sort of how the Pillar 2 impacted global tax policy, you could arguably say that is a win for the OECD, right? Now, one of the other goals was to stop the competition for foreign direct investment, and I think that was always going to be a challenge.
Yeah, well, so let me just stop you there,
Please.
Because I really cannot resist. Let's face it. I mean, Pillar 2, as with Pillar 1, as with BEPS 1.0, is actually really about large countries protecting their own tax base. So this is not about stopping tax competition. This is about preserving what you already have, okay? And, there have been, one of the reasons why there has been this push against credits in Pillar 2 is because that enables other countries, you can call it tax competitiveness if you want to, but that enables other countries to attract investment so they can build up their infrastructure, so they can get to the place where the developed countries already are. This is one of the reasons why the developing countries have pulled away from this, is because they see the large countries, developed countries, trying to hold on to whatever they've got and stopping others from building up. And, that's an argument which I think we have to pay some attention to.
Right. And, we'll continue to see how this progresses. But I think one of the other questions that it begs is, if Pillar 2, with Pillar 1 Amount A, we'll see what happens with Amount B and Pillar 2. Sure. Has the OECD potentially lost some credibility with what some of their original goals were, and now we're seeing the UN take a much bigger role, or potentially try to take a bigger role in global tax policy. And I'm very interested to see, as we look forward to 2025, 2026, how those roles could compete or change.
Yeah. So I mean, I in the end don't think that either of the original goals of Pillar 1 or Pillar 2 have been met. Pillar 1, as far as I'm concerned, was, and still is, had a real question when it started, which was, in the 21st century, you can create value, you can earn profit in a country without really being physically present there. How do you tax that? That is still a genuine open question, which Pillar 1, Amount A, does not address. Okay, so that's that. On Pillar 2, it was about, tidying up after BEPS. Race to the bottom, as I say, I think BEPS 1.0 had stopped that already.
Yeah.
But there were some things which should be done. But what December 2021 and those rule changes did was they changed this, for example, particularly with the undertaxed payment rule, from being about BEPS, base erosion and profit shifting, to being about tax harmonization. And that is a very, very different undertaking. And so I'm not sure that either of those was completely done. As far as the UN is concerned, I mean, that speaks in part to many smaller countries simply feeling they didn't get a fair shake of the stick in Paris. Also there are some very large, it's hard to call China and India developing countries, but there are some very large countries involved in the UN process who, again, outside of the G7, have felt that they, again, haven't had a full role in this, which was designed, particularly Pillar 2, largely by both of the pillars, by the G7. So, there is a different dynamic there as well. The UN, as a majority-based organization, rather than a consensus-based organization, which is what the OECD at least is meant to be, can adopt things by majority vote and will, most likely adopt this new International Tax Convention or Convention on International Tax Cooperation by majority vote. But, they had a vote recently, and the EU, which abstained, the EU 27 abstained in that, but they said, if we don't do this by consensus, we're going to pull out of this. So, we face the position where the UN does something, but the US voted against it, the UK voted against it, the EU abstained and may pull out of that. So again, you have a number of large countries which would need to be part of this in order for it to be a global structure who won't be part of it.
Yeah, and that, to the point, is why that you can say that's in peril. Sure. It doesn't mean that it's dead. No. On the developing countries point, I had the opportunity, Will, this fall to go to South Africa and meet as part of our African Tax and Business Symposium, and actually sat on a panel with one of the people from the South African Revenue SAR, who's responsible for implementing Pillar 2.
Yep.
And there were countries from all over represented at that conference. And it was I haven't spent much time on that continent and consider myself more of a practitioner than a policy person. But it was very eye-opening for me, the challenges that developing countries have focused on individual taxation, getting people into the system, this concept of an informal economy. And I had a lot of sympathy for the South African team that is responsible for developing these Pillar 2 rules, and that there are many other priorities that they have. And then the question is, well, how much revenue are they even going to be able to gather from this? And I think that's not just in South Africa, in many countries, except for maybe Ireland and Singapore and some of these other countries that have had lower tax bases, are not going to seek that additional revenue. But it was really eye-opening for me to understand what they're dealing with locally, and how they feel, particularly with this OECD process, that maybe they're not getting exactly what they had signed up for, and now having to deal with this just significant complexity of developing forms and a process to be able to deal with Pillar 2.
No, I agree. I mean, I have a huge amount of sympathy for that. Don't get me wrong. I mean, I think a bunch of developed country tax authorities are going to have a whole problem with it.
Fair enough.
And you've made your plug already for the Pillar 2 tool, but thank heavens for that. Because I think most taxpayers would have a huge problem with it as well. But to go back to this idea of one tax organization, this is an idea whose time, I think, has both come and now gone. The world is too different. The interests of large economies like the US are very, very different,
for sure,
to the interests of small countries. Small developing countries. Within developing countries, there are big differences between resource-rich developing countries and resource-poor developing countries. Within Europe, small and large countries, because depending on what, if you're looking at formula apportionment, if you have a factor based on payroll, for example, you may get a different result to something based on, the value of IP, for example. Likewise, sales. So all of these things can skew towards large countries, away from small countries, away from developing countries, away from countries where prices are lower, where wages are lower, all of that type of stuff. So one tax organization with one system, particularly when you look at Pillar 2, which is essentially, as I said before, is about harmonization, you get a real disconnect and a dissonance there. And, in the longer term, I don't know whether this is a guess or a prediction or what it is, but, I actually think that if we have the OECD over here representing some of the more developed, wealthier economies, and the UN over here representing, some of the developing economies, and then those two groups talk to each other rather than trying to harmonize under one umbrella, you may get better results than what we're currently getting. But I think we are, unfortunately, a ways away from that as well.
That's a great perspective. I like that. All right, so last topic here I want to cover. I kind of want to bring some of this together between the U.S. election, DSTs, Pillar 2. And remind listeners of some proposed legislation that the Republicans put out in 2023. So it was Republicans from the U.S. House Ways and Means Committee that introduced the so-called Defending American Jobs and Investment Act. The proposed legislation would increase income tax and withholding tax rates, initially by 5 percentage points, increasing up to 20 percentage points on certain foreign citizens or non-U.S. citizens, foreign corporations, and foreign partnerships of any foreign country that is listed in a report on the extraterritorial taxes and discriminatory taxes of foreign countries. So this is a report that would be submitted by the Secretary of Treasury to congressional committees. Presumably this includes both DSTs and UTPRs. So this legislation will, when it comes out, and I think this is very sometimes difficult for people that don't live within the U.S. political system to understand, that was introduced knowing that there was no chance that was going to move forward. Like President Biden wasn't going to agree with that, the Democrats with the majority in the Senate, but it was at least proposed.
Yeah.
What we've seen in the past is legislation that has been proposed with no hopes of being enacted in a current Congress can then sometimes sort of be taken off the shelf, so to speak. Now we have a Republican president, incoming Republican president, incoming Republican Congress. This has broad impact for inbound investment into the U.S., frankly, for secondees that may be based here in the U.S., supporting a foreign business or just here for other reasons. Yep. What should those inbound investors and secondees in the U.S. be aware of, be concerned? Is this, what is your views on, is this something that could be taken off the shelf and potentially included to raise revenue, for example?
Yeah, so, gosh, there's so much stuff there.
Yeah, there's a lot there.
So, firstly, take it very, very seriously, because as I said, by the end of 2025, the UTPR is going to be it is going to be a burning platform. It's going to be real hair on fire stuff. There are very slim majorities, particularly in the House, but also to a certain extent in the Senate. But there is a reconciliation procedure, which,
we've talked about at length with Roe. You can listen to the Roe podcast.
Okay,
yeah.
So we have the reconciliation procedure, which allows you essentially to skate through on 50% as opposed to, or 50 point something, as opposed to needing to meet the filibuster rules and all the rest of that. If this is potentially revenue raising, then maybe it gets through under that. So you can put that in there. Also, if we get closer to this, I would be surprised if some Democrats weren't also concerned about the taxation of U.S. domestic income. Particularly when it comes, particularly because of the use of, because of the way the credits work under the Pillar 2 base as opposed to the US base. So, I do think that we'll see this. Now, yeah, it clearly is aimed at the UTPR. It's also aimed at DSTs. The legislation which came out last year had not every definition was fully spelled out.
Right.
Let me put it like that. And there were issues about, what qualifies as discriminatory. And all the rest of that. My guess is that will get tidied up. There has been a provision sort of like this in the code for, 90 years now? 891.
Right.
Too nuclear to use because it would double the taxes immediately. But this is more thoughtful. It steps it up by 5% a year. It is intended to increase pressure. So you asked about, what should inbound businesses do? What should inbound individuals do? I would talk to your own government about it, because nothing can change. The rules are the rules, all the rest of that stuff. This is a political issue. Don't get me wrong. It needs a technical solution to make it work. We have to go back to the basic fact here, which is the building block at this point of the global minimum tax is the EU directive. And therefore, people who say, we need to go back and renegotiate this at the OECD. No, why do you need to go back to the OECD to renegotiate it? You need to talk to the EU about this.
Yeah.
Because what you need to do is to thread a needle which gets this into a safe harbor, essentially. Because, as we all know, to get an EU directive requires 27 votes. What people forget is to repeal an EU directive also needs 27 votes. I think that's highly unlikely. Even with some of the ructions going on in Europe at the moment, I still think that's quite unlikely. So you need to get this through the safe harbor. How do you do that? I don't know. At least I certainly don't know yet. There are issues about the country-by-country calculation provision in the EU directive as well. But you need to do that. In order for that to happen, people need to talk to their national governments, particularly in the EU, about how that change needs to happen. If the EU will make that change, my guess is that others will as well. And so whether that's an extension of the current UTPR safe harbor, whether it's a different type of UTPR safe harbor, whether it's something, again, a safe harbor of a different type, if the EU does that, other countries, my guess is, will fall into line on that. Likewise, if the European Court of Justice, admittedly this would be in a year or two, on this Belgian case says, actually, no, this stuff is, this is contrary to the four freedoms, then everybody's going to have to rethink it. But again, this is not an OECD renegotiation at this point. Sure, they will continue to produce guidance for a while, but actually at the political level, this needs to happen at the EU. And therefore, that's why people are already talking about the 23 legislation coming back in 25, because that applies political pressure. It gets people to the table to talk about this.
All right. Well, that's where we're going to have to leave things. I feel like we could do a 3-hour
probably
podcast at
could.
some point.
But at some point, somebody would switch off.
Yeah,
so.
maybe. I think we're interesting.
Yeah, me too. But then I'm kind of biased. So.
All right, well, fascinating conversation. A lot of developments in 2024, lots to think through with 2025. And as those happen, we'll bring you back to talk about it on the Cross Border Tax Talks podcast.
I will look forward to it. Thank you, Doug.
All right. So thanks for tuning in to this week's episode of Cross Border Tax Talks. Thank you, Will Morris, PwC's Global Tax Policy Leader. I'm Doug McHoney, PwC's International Tax Services Global Leader. Stay tuned for another exciting edition of the Cross Border Tax Talks podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.